There's something most retirees don't realize. If you have more than $250,000 sitting in your retirement accounts, the IRS already knows about it. They've known about it for years. Not because someone reported you, not because you did anything wrong, but because the system is built to watch. Every IRA custodian, every 401(k) administrator, every brokerage and bank, they all file forms with the IRS every single year. Your balances, your contributions, your rollovers, your distributions. All of it gets reported automatically, and the IRS has computers that cross-reference every single one of those forms against your tax return. If something doesn't match, their system flags it. No human even needs to look at it for that flag to appear. Most people think the IRS only cares about millionaires and billionaires. That's not how it works. The truth is, if you have $250,000 or more saved across your retirement accounts, you are generating enough taxable activity to land on the IRS's radar in ways you probably never expected. So today, let me walk you through exactly how the IRS monitors your retirement money, the common mistakes that set off red flags, and the calm, practical steps you can take to protect yourself. No panic, no fear, just clear information you can actually use. Let's start with the paperwork, because that's where the watching begins. Every year, your IRA custodian files something called Form 5498 with the IRS. That form reports your year-end balance, every contribution you made, any rollovers, and any Roth conversions. You may never even see this form, but the IRS gets a copy every single year. If you have a 401(k), a 403(b), a 457, or a TSP, those plan administrators file their own annual reports too. Form 5500 discloses total plan assets, and every time you take money out, a Form 1099 gets filed telling the IRS exactly how much you withdrew, what kind of account it came from, and what type of distribution it was. On top of that, your banks report interest income on Form 1999, your brokerage reports dividends on Form 1099 DV. If you have foreign accounts worth more than $10,000 at any point during the year, there's FAR reporting, and possibly FATCA reporting, and the penalties for missing those can be $10,000 per year per account. The point is this: the IRS doesn't need to come looking for you. The information flows to them automatically. They already have the numbers. The only question is whether those numbers match what you put on your tax return. Now, why does $250,000 matter? There's no official IRS threshold that says this is the magic number, but practically speaking, this is roughly where things start to get complicated for retirees. At $250,000 in a traditional IRA, your first required minimum distribution at age 73 is somewhere around $9,400 to $10,000. That alone might not sound like much, but add it to Social Security, maybe a pension, maybe some investment income, and suddenly your total income is high enough to push more of your Social Security into the taxable column. It's high enough to trigger Medicare premium surcharges, and it's high enough to put you into a bracket where the IRS's automated matching systems pay closer attention. The IRS uses something called a discriminant inventory function score, or DIF score, to rate every tax return by its audit potential. Returns with more complexity, more forms, more income sources, they tend to score higher. And retirees with $250,000 or more almost always have that complexity. Multiple accounts, multiple 1099s, maybe some Roth conversions, maybe a rollover or two. Each one of those is another data point the IRS can cross-check. Let me walk you through the most common mistakes that actually set off those red flags. The biggest one is missing a required minimum distribution. Once you hit R&D age, the IRS expects to see a 1099-TR from every account that requires a distribution. They already know your balance from Form 5498. If no distribution shows up, their system catches it. The penalty for missing RMD is 25% of the amount you should have taken. If you catch it quickly and file the right paperwork, it can be reduced to 10%. But if you don't file at all, the IRS can assess the full penalty plus interest. Another common mistake is aggregating RMDs incorrect. With traditional IRAs, you can calculate the RMD for each IRA separately, but then take the total from just one IRA. That's allowed. But with 401 clans, you cannot do that. Each 401 must take its own separate RMD. A lot of retirees hear that you can combine RMDs and they think it applies to everything. It doesn't, and the IRS catches this through mismatched distribution codes on your 1099-R forms. Inherited accounts are another trap. If you inherited an IRA or a 401(k) IRA, you likely have your own separate RMD schedule, and it's completely different from your own accounts. Many beneficiaries don't even realize they owe distributions on inherited accounts, especially if they're under 73, but the IRS knows that account exists because the custodian reported it. Now let's talk about Roth conversions, because this is where a lot of well-intentioned retirees accidentally create problems. When you do a Roth conversion, money moves from your traditional IRA or 401(k) into a Roth account. The traditional account custodian files a 1099-R showing the distribution. The Roth custodian files a 5,498 showing the contribution. The IRS matches those two forms. If they don't line up, you get a letter. But the bigger issue is what a large conversion does to your income that year. A $100,000 Roth conversion adds $100,000 to your adjusted gross income. That can push you into a higher tax bracket. It can cause up to 85% of your Social Security to become taxable. And it can trigger IRS surcharges on your Medicare premiums. Not this year, but 2 years from now, because Medicare looks at your income from 2 years prior. Most people only find out about IRMA when they get a letter from Social Security saying their premiums are going up. By then, the income event that caused it happened 2 years ago. You can't undo it. The only appeal is if you had a qualifying life-changing event, like retirement or the death of a spouse, and you file Form SA-44. Here's another Roth conversion mistake that catches people. You cannot convert your RMD to a Roth. The IRS says you must take your RMD first. That RMD amount is not eligible for conversion. Only any additional amount you withdraw above the RMD can be converted. A lot of people don't learn this until after they've already tried it, and their tax preparer has to unwind the mess. And there's one more layer to Roth conversions that trips people up: the 5-year rule. Each Roth conversion has its own 5-year clock. On the earnings side, if you withdraw gains from a conversion before 5 years have passed and before age 59 and a half, you can owe both income tax and a 10% early withdrawal penalty. The IRS tracks each conversion separately. So if you did conversions in 2023, 2024, and 2025, each one has its own 5-year window. It's not one clock for all of them. Let me also mention a few audit triggers that most retirees have never heard of. The 60-day rollover rule. If you take a distribution from an IRA and don't redeposit it into another qualified account within 60 days, the IRS treats it as a taxable distribution, and you only get one indirect rollover per 12-month period across all your IRAs. Do 2 in 1 year, and the second one becomes fully taxable. Coding errors on rollovers. When you do a direct rollover from a 401(k) to an IRA, the 1099-R should show distribution code G. If it's coded as a normal distribution, code 7, the IRS thinks you took the money out and owes tax on it. It's on you to prove it was a rollover. This happens more often than you'd think, and it generates IRS notices that scare people unnecessarily. Qualified charitable distributions reported incorrectly. A QCD is a wonderful tool. If you're 70 and a half or older, you can send money directly from your IRA to a qualified charity. It counts toward your RMD, but doesn't increase your adjusted gross income. But it has to be reported correctly on your tax return. The full distribution amount appears on your 1040, and then the QCD portion gets subtracted. If your tax preparer just leaves the distribution off entirely, the IRS sees a 1099-R with no matching income on your return and sends you a notice. And excess contributions. The IRA contribution limit for 2025 is $7,000 or $8,000 if you're 50 or older. If you contribute more than that, there's a 6% penalty per year on the excess until you fix it. The IRS knows about the excess because your custodian reported it on Form 5,498. Now, what can the IRS actually do if they find a problem? Most of the time, it's not an audit. It's an automated notice. The IRS has something called the Automated Underreporter Program. Their computers match your return against all the information forms they received. If something doesn't match, you get a CP 2000 notice in the mail. It proposes additional tax, interest, and penalties. No human reviewed your return. A computer found a mismatch and generated a letter. Most of these notices are resolved with a phone call or a letter back, especially if you have your documentation organized. For R&D penalties, the assessment comes through Form 5329. For accuracy-related issues, the IRS can add a 20% penalty on top of the tax you owe. In extreme cases involving willful non-compliance, civil fraud penalties of 75% can apply, though that's rare for honest retirees who simply made a mistake. The statute of limitations is generally 3 years from the date you filed your return, but it extends to 6 years if you omitted more than 25% of your gross income. And there is no statute of limitations for fraud or for returns that were never filed. Alright, take a breath. That's a lot of information, and I know some of it might feel heavy, but here's the good news. Staying on the right side of all this is not complicated. It just takes a little organization and a little awareness. Step 1. Keep every Form 5498, every 1099-R, every 1099-9. Arg990. If the IRS sends you a notice, your first line of defense is documentation. Most notices get resolved simply by showing the IRS the paperwork they already have. Step 2. If you've ever made non-deductible contributions to a traditional IRA, file Form 8606 every single year. This tracks your cost basis. Without it, the IRS assumes every dollar you take out is fully taxable. Step 3. Take your RMDs by December 31st. Yes, in your first RMD year, you technically have until April 1st of the following year. But if you use that delay, you'll have 2 RMDs in 1 calendar year, and that double income can push you into a higher bracket, make more of your Social Security taxable, and trigger IRS surcharges. For most people, taking that first RMD by December 31st is the smarter move. Step 4. If you're doing Roth conversions, spread them out. Don't convert everything in 1 year. Fill up your current tax bracket, not the next 2. A series of smaller conversions over 5 or 10 years usually produces a much better tax result than one giant conversion. Step 5. If you're charitably inclined and you're 70 and a half or older, use qualified charitable distributions. They satisfy your RMD. They don't increase your AGI, and they can protect your Social Security and Medicare premiums. Step 6. Review your tax return every year for coding errors. Make sure rollovers are coded correctly. Make sure QSDs are reported correctly. Make sure your RMD amounts match what your custodian reported. A 10-minute review can prevent a 6-month headache with the IRS. And Step 7. Consider working with a CPA or enrolled agent who specializes in retirement taxation, not a generalist. Someone who deals with RMDs, Roth conversions, and IRA planning every day. The cost of a professional review is almost always less than the cost of a single penalty. Now, here's the part I really want you to hear. The IRS is not out to get you. Their systems are designed to catch mismatches, and retirees with $250,000 or more simply have more accounts, more forms, and more opportunities for mismatches. That's all. But fear of the IRS is real, and it leads a lot of retirees into a different kind of mistake. They're so afraid of doing something wrong that they don't touch their money at all. They take only the bare minimum RMD. They never do a Roth conversion. They never use QCs. They sit on their savings while their healthiest, most active years pass by. And then in their late 80s and 90s, the RMD percentages climb to 6, 7, 8% or more. And they're forced to take large distributions they don't even need, paying higher taxes in years when they're doing less and enjoying less. The IRS minimum was never designed to be your retirement plan. It was designed to tell the IRS how fast to force taxes out of your accounts. That's it. Your retirement plan should start with a different question. What kind of life do I want in my 60s and 70s? And then you fit the taxes, the RMDs, and the account strategies around that life. Think about it this way. Tax planning is like a health checkup. You don't go to the doctor only when something hurts. You go regularly, preventively, calmly. You catch small problems before they become big ones. That's exactly how you should approach your retirement accounts in the IRS. A little attention each year saves you from a lot of stress later. So here's your quiet next step. Sometime this week, pull up the most recent Form 5498 and Form 1099-R for every retirement account you have. Put them in one folder. Check that the numbers on those forms match what's on your last tax return. If everything matches, you're in good shape. If anything looks off, that's your signal to call a professional before the IRS calls you. And while you're at it, write down every retirement account you have. Traditional IRAs, rollover IRAs, old 401, KS 403, BS, TSP, any inherited accounts. Next to each one, note whether it's from a current employer or a past employer, and whether you've been taking distributions from it. That simple list can be the most valuable piece of paper in your financial life, because it shows you where the IRS is looking and whether you've covered every base. You don't have to become a tax expert. You just have to be willing to stay organized, ask a few calm questions, and make thoughtful choices. The IRS is watching, but if you're paying attention too, there's nothing to be afraid of. Take care of yourself. Take care of your savings. And remember, you worked a lifetime for this money. You deserve to keep as much of it as the law allows.